Hi, my name is Ravi. Welcome to my channel Payment Talks. This is the first of the many explainer videos where we try to demystify the complex concepts of payments world. In this video, we start with basics. We first try to understand what a payment is and its brief evolution. Then we will try to understand the domestic and international payments setup and how they differ in their setup. Payments are the cornerstones of economic activity. From the early days of bartering to the rise of cryptocurrencies, the evolution of payment methods reflects humanity's progress in technology and trade. While domestic payments cater to transactions within a country's borders, international payments facilitate cross border exchanges, connecting economies worldwide. Let us first understand the brief history of payment evolution. The concept of payments has evolved alongside human civilization, adapting to societal, technological, and economic changes. From primitive barter systems to digital currencies, the history of payments reflects the continuous quest for more efficient and secure methods of exchanging value. Here's a detailed look at the major milestones in the evolution of payments. The earliest form of payment during prehistoric era is called barter system. It involved the direct exchange of goods and services without a standardized medium of exchange. It relied on mutual need. For example, a farmer might exchange grain for a blacksmith's tool, but it has limitations. Inefficiency in matching needs, lack of divisibility, and difficulties in storing wealth are few of the limitations. Next, around 3000 BCE, usage of commodity money started. Societies began using valuable commodities such as salt, cattle, or shells as a medium of exchange. Though this addressed barter systems inefficiencies by providing a standard medium for trade, it too had limitations like it was bulky, difficult to transport in large quantities, and vulnerable to theft. Then, around 600 BCE, coinage started. Coins were standardized in weight and value, making transactions simpler. Coinage established the foundation for currency systems and facilitated long distance trade. Around 7th century AD, after the invention of paper money came into existence. Paper notes represented a promise to pay the bearer in precious metals or commodities. This was more convenient than coins for large transactions. It has advantages like lightweight, easily transportable, and scalable for growing economies. It too has challenges like risk of counterfeiting and reliance on trust in the issuing authority. During medieval period, banking evolution started. Banks offered safekeeping, loans, and money exchange services. Banks introduced letters of credit and promissory notes to facilitate trade. Banks also issued checks, which are written orders directing banks to pay a specified amount. They provided a secure alternative to carrying cash. Banking institutions became central to financial systems, and checks allowed greater flexibility in payments. In 20th century, digital revolution took place. Electronic payments started. Innovations like credit cards and ATMs happened. Payment networks such as SWIFT enabled international transactions. Banks began offering online payment systems, allowing individuals to transfer money electronically. This had many advantages like speed, convenience, and reduced reliance on physical cash. In 21st century, mobile wallets integrated directly with smartphones, making payments contactless and instantaneous. Example PayPal, Venmo, Apple Pay, and many more. QR codes and NFC technologies became mainstream. This significantly impacted financial inclusion of masses. Few examples are M-Pesa in Kenya and UPI in India. Today we are seeing the rise of cryptocurrency using blockchain. Blockchain technology was introduced in 2009 with the launch of Bitcoin. Blockchain enabled decentralized, secure digital payments. Cryptocurrencies serve as both a payment medium and an investment asset. Few examples of cryptocurrencies are Bitcoin, Ethereum, and other stablecoins like USDC. Cryptocurrency promises faster, cheaper, and borderless payments but faces regulatory and scalability challenges. Future trends like CBDCs, AI, and payment automation and biometric payments are yet to be unfolded. What is a payment? In our current context, a payment is a transfer of money, funds, or value from one party, who is called the payer, to another party, who is called the payee, in exchange for goods, services, or to settle a debt or obligation. Now, payments can occur through various channels, including in person transactions, online platforms, automated payment systems, and mobile payment technologies. Let us understand the key components of a payment. First, we will have a payer. This is the individual or entity initiating the transfer of funds. These funds are sent to another individual or entity called payee. Payee is the recipient of the funds. Then comes the payment instrument. This is the method or tool used to execute the payment. Payments can be made in various forms, including cash, checks, credit or debit card transactions, digital or cryptocurrency, and electronic transfers. To facilitate the payments, we have financial institutions, payer bank and payee bank. These financial institutions are connected to a process or a system called clearing and settlement mechanism. Clearing and settlement is the process by which the payment is validated, called clearing, and funds are transferred between financial institutions called settlement. This is the key process in the payment life cycle. Depending upon the scenario and where the payer and payee and their financial institutions are located and the payment instrument used, this clearing and settlement mechanism varies. Let us now understand the setup, how this clearing and settlement mechanism is set up for domestic and international payments. First, we look at what domestic payments are and their setup. Domestic payments refer to the transfer of funds within a single country or single monetary regulated area involving the local currency and adhering to the country's financial regulations. These transactions are settled in the local currency and typically do not require foreign exchange or cross border mechanisms. First key component of a domestic payment setup is its central bank or any other central authority. It acts as the primary regulator and overseer of the payment systems. It often provides the core infrastructure for interbank settlements, for example, RTGS, ACH, or instant domestic settlements. Please refer to the article in the description for more information on the domestic clearing mechanisms. Coming back, central bank is the central authority that maintains monetary stability and ensures system-wide liquidity. Then we have commercial banks and financial institutions. They facilitate customer access to the payment system through accounts, cards, and other instruments. They participate in clearing and settlement processes for interbank transactions. Then we have customers. These are the payers and payees who are facilitated by these financial institutions to exchange the funds using payment transactions. One other key component is clearinghouse. These are intermediaries that validate and process payment instructions between banks before settlement. They play crucial role in the payment life cycle by validating all the transactions. Central bank and clearinghouse together provide the required regulatory framework. They define operational standards, security measures, and compliance requirements for all participants like commercial banks, financial institutions, customers, and payment service providers. Payment service providers include fintech companies and non-bank entities which provide alternative to commercial banks. They offer digital wallets, mobile payment solutions, and other innovative services. They enhance accessibility and convenience for users. Now, in the subsequent videos, we will cover the step-by-step detailed process involved in the clearing and settlement mechanism of domestic payments like net settlement, gross settlement, and instant payments. Now we look at what cross-border payments are and their setup. Cross-border payments refers to transactions where the payer and the payee are located in different countries. These payments are essential for international trade, remittances, global business operations, and investment. Setting up cross-border payment systems involves a complex infrastructure that facilitates the secure, efficient, and timely transfer of funds across borders. Let us compare these cross-border payments with domestic payments to understand the differences in their setup. Person A living in a country has his bank account with Bank A. His friend B lives in another country. She has her bank account with Bank B. This person A wants to send money to person B. Person A initiates a bank transfer using his Bank A with beneficiary as Bank B and her account details. In a domestic payment scenario, both the Bank A and Bank B are connected to a local clearing and settlement system. And this system is responsible for the funds movement. Since both the banks are located in different countries, there is no such central system which regulates the payment. In a cross-border payment setup, the banks maintain interbank relationships. These banks are connected to each other using a network like SWIFT. These networks serve as the backbone for communication between banks globally. These networks do not handle funds directly, but enable the messages between these banks. The actual movement of funds, that is settlement, happens through a system called as correspondent banking, where banks establish Nostro and Vostro accounts with each other. These accounts also manage the foreign currency transactions as these are held in different geographies. In this instance, Bank A, payer's bank, sends the payment instruction to Bank B, beneficiary's bank, via SWIFT. Bank A's Nostro account with Bank B is debited and Bank B credits the beneficiary account. In the subsequent video, we will analyze the correspondent banking in detail. We will take step-by-step approach to understand Nostro, Vostro accounts and their relationships in practical manner. When the payer and payee bank does not have Nostro-Vostro relationship with each other, then they will try to find common correspondents, aka banks that have relationship with payer and payee bank to settle the payment. These intermediary correspondent bank or banks can be in either Bank A or Bank B geographical location or in any other location. Cross-border payments must adhere to AML, anti-money laundering, KYC, know your customer, and other regulatory frameworks imposed by multiple jurisdictions wherever the payment instruction travels. Hope this video gives the glimpse of the payment, its evolution, and domestic and international payment setup. Thanks for watching this video. If you like this video, please like, subscribe, and share for more such interesting topics on payments.